Welcome to the Market Huddle with Patrick the Content Machine Serezna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
It's March 1st, 2019, episode number 17. I'm Patrick Serezna.
And I'm Kevin Muir. Thanks for joining us this week.
Now, this show is broadcast as both a podcast and on YouTube. So if you're enjoying this as a podcast and feel like you're missing out on the charts and videos we're referencing, you can register at the markethuddle.com website to get the weekly email that includes the chart pack and video links, or just flip over to YouTube.
In this week's episode, we welcome special guest Steve Sosnick, the chief strategist at Interactive Brokers, who will be doing a deep dive into what he is watching in the global financial markets.
In this week's trading history, we're going to go back to 1933 to discuss Glass-Steagall.
And for the WTF clip of the week, Powell gets asked a pressing question.
And then, of course, we're going to end with the top 5 most important things to watch next week. So let's jump right into it.
Okay, Patrick, who's our beer brought to us by this week?
This week, we have the beer. It's called the Green Bastard IPA. And this is a particularly strong beer, it says. Oh my God, this is the Trailer Park Boys beer.
Oh, is it really? I had no idea. I thought it was actually very fitting because of AOC's Green New Deal. I thought this would be a great beer for us. So let's open it up and see what it tastes like.
Ooh, that's strong.
That is
no
strong.
Kidding, eh? But
very fitting of the Trailer Park.
We're going to start slurring by halfway through this show.
Patrick, it'll be nothing new.
Anyway, listen, why don't you quickly give us the disclaimer?
That's right. Let me do my stuff. Clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. For more information, please visit eastwestfunds.com. Side effects of too much market huddle may include itchy rashes, gigantic eyeball, and or the condition known as constant scromiting. Go see a doctor if these conditions persist.
All right. Well, thanks for sharing. Well, first off, let's welcome Steve. Steve, how you doing?
I'm great, thanks. How are you?
Oh, I'm doing great. We're just watching what was a pretty crazy week, and we want to get what's on your mind. So why don't we jump right into it? So, Steve, we always start off with a guest to talk about what's the most important event of the week or what's on your mind. And so we kind of wanted to pick your brain. So you were nicely sent us 4 cool charts, and I think they're going to tell a fun story. So why don't we just jump right into it and take a look at what you're thinking?
Sure. The first chart I sent was basically, it's a very busy chart. So I apologize if it's tough to read. But basically, the question on my mind is volatility rich or cheap right now? And unfortunately, from looking at the chart, the answer is both. And it really depends on your point of view. You've got basically the S&P trading with an implied vol of about 11. And you may say, well, that seems very low. And relative to the VIX, it is, because the construction is different. But just bear with me on that one. So the VIX and the implied volatility on the SPX are not always exactly the same, depending on which options you're looking at. But we'll use an 11. And so what you would say would be, well, if you're looking at short-term realized volatility, historical volatility, the 7-day is 5.5, or the 20-day is 8.5. And well, so if you buy, so at 11, the vol's kind of expensive. If you look back and see the 60-day at 21, which still encompasses the December and January bouncing around, or even the longer term vol, 200-day moving average of 200-day implied vol of 16 and change. Well, 11 seems kind of cheap. So you really, this will be a theme you'll see, is I think we're really at kind of a crossroads here. Is vol rich or cheap? Is the market rich or cheap? And I think you can make a good case for almost anything right now, and I think that's kind of the problem.
Steve, I have to ask you then. It's a simple question from this perspective. Like in my mind, at least from what I've been sharing with people, is that I did not. If this was a bear market and this is a bear market rally, I was highly suspect that we were going to see volatility normalize back to the pre-crash level where we were down in the VIX, down in the 10 to 12 level on the downside. I thought that we were going to have a little bit of a higher sustained vol, which to me, I would think that therefore there isn't too much Vega risk in taking on options right now. But do you have a different perspective on? Do you think that we can normalize all the way back to like September levels from last year?
Well, first of all, I don't think September levels of last year were all that normal. The normal historically is sort of the mid-teens, not the low teens. I think we got lulled into a situation where we accepted low teens or even less on the VIX as being the normal state of affairs. Historically, that's not really the case. Now, I will say that I did think this was a bear market rally at first, and I am on record somewhere. If you go through my tweets, you'll see somewhere that I was quoted as saying I thought that vols would normalize in the high to mid-teens. And
right. I was in your camp, to be honest.
That's wrong. Yeah. So we agreed, and this rally was stronger, I think, than I anticipated. At this point, it's not a bear market rally. I don't know what to make of the decline, other than to say maybe in hindsight it looks just like an anomaly. But that was one hell of an anomaly.
Yeah, no, that was pretty crazy. Now I'm just going to give you a chart here. Just this is the traditional VIX chart using candlesticks, and we can see at least this VIX chart is down in the 13.5 level on this CBOE index. I mean, the levels that in my mind, that were all these major lows are not that far away, are they?
No.
And
go ahead.
No. It's I'm just curious. Like, I mean, are we heading all the way back down there?
I would have said no. Now I'm less certain of that call. One thing I did learn over the years is you have to be able to admit when you're wrong and not dig into a position too much. I think some of the other stuff we'll look at makes me somewhat uncertain. The one thing I would say here is, and I've said this multiple times over the past few years, when it gets down to these levels, it's really treacherous for the average trader to try to short volatility, because your risk reward is completely skewed.
Right.
What are you going to make? 2 points maybe? And what can you lose? 5, 6, 10? You lose those in a day and a half.
There's no more asymmetry in that.
Yeah, so it's a very asymmetrical trade right now. And so what I would say would be, if you think the vol's too high, well, then don't buy it, but be very careful about trading it from the short side.
Kev, what's your thinking? Do you have an opinion?
Well, I think that I think Steve's point about whether VIX is going back to the low levels that we saw kind of in the past couple of years is interesting. I wonder if too many people were expecting that bear market rally and were in your camp, and I wonder if this is just a squeeze, and we're going to see when people finally give up on kind of shorting it is when we're going to actually see vol go. And I'm not sure whether that's going to be 13.5, which I see we ticked at today, or whether that's going to be 11.5, or don't forget, didn't we kind of threaten single digits at one point?
Yeah. Back then, I'm skeptical of that. I mean, that's truly a really interesting period if the market was to once again, like, it's almost like that, all the different vol blow-ups we've seen, it's almost like the lesson was never learned, right?
Yeah, but I think back to Steve's point, though, about the realized vol, and Steve cautions against regular folks going out and shorting vol here, and I completely understand that. But if you think about it from an institutional trader, like someone that's actually doing this for a living, if they're shorting, 13.5 or whatever it is, and it's realizing 10 or 8, then they're making money. And that can go on for a long time, and that can pay for a lot of mistakes. So the difficulty is that if we don't get something that really makes the market move, and if we go kind of like if it gets lulled into this point of it just kind of going back to where we were before, where nothing really exciting is happening, then buying 14s is going to be a losing trade just as much as you caution against selling 14s, but buying 14s in that kind of environment is also dangerous because that's costing you, and you're just getting eaten away by carry all the time.
Oh, absolutely. Yeah. I mean, that's the problem right now is, going back to, when you look at this, the short-term historicals and what the vols that we're realizing do not pay for your decay at this point. Even if you're very astute at gamma hedging your gamma, it's not there. You're not getting the back and forth, and so you're getting at this sort of stasis. One of the things that I don't really see us one of the reasons I don't really see us getting back to, let's say, threatening single digits is the backdrop is different. I think you had the extraordinary circumstance throughout 2017 and early 2018 of an extremely accommodative Fed, and then an extremely accommodative in the U.S. fiscal policy, and that basically just put this floor under the market. You could argue, was it the Powell? Was the Yellen put there? And I think the market just sort of always saw this wave of money, and it's very easy to buy the dip when you think that there's this wave of money behind you, and therefore, why do you need to hedge? Because if it's not going to go down too far, because every dip is going to be bought and it's just a buying opportunity, well, I don't really need to hedge. That unraveled somewhat in February of 2018. When the vols exploded, because I think the short vol trade became way too crowded and people got into products they didn't understand. Then people, of course, tend to forget things, and the trade sort of the vol sort of reasserted itself on the downside. Throughout the summer, we had quite a summer rally, and then it came right back down. Then the vol popped and the market came down again. It's that's why I hate to think that we're going to be that schizophrenic, but I think that's what we're seeing. And part of the thing that comes into it now is I think we're so driven by FOMO, fear of missing out, particularly among institutional investors who have to be invested, who see these gaudy year-to-date numbers, and you don't want to be the guy not invested. And so I think that's a lot of what we're seeing is just, this fear of being the guy left on the sidelines. If you look back and say, well, the market's actually down over the last 6 months, but if you look at it year to date, and that's how a lot of these guys are getting measured, if you're not up something close to double digits, your job's at risk. So you got to be in there.
Do you think that a lot of guys on the institutional side missed this? Do you think that there was a lot of selling into December and the guys were under positioned? Like, obviously there must have been a fair amount of that, but what extent do you think that our people still underinvested and waiting to get in, waiting for the decline to buy? Like, how many guys are sweating it out right now saying, geez, I hope we get kind of a 3% or 5% dip so I can buy it?
I think that there's fewer and fewer each day. I think now what you're also starting to get are, the people who don't necessarily have to be invested, with their FOMO, because, you just, the anecdote of like my wife's friend telling her about like her great broker and how she's getting back in the market because it's zooming, and it's like, really now? Where were you all along?
No shit. Like that's, the timing on that is just not. It's amazing. It's the reaction function, right? On the way down, no one wants to touch it with a 10-foot pole, show a 10% return in 1 month, and everyone needs to buy because they fear of missing out. It's amazing the behavioral element of the markets, isn't it?
Absolutely. Well, my comment is, if you're an institutional investor and you have fear of missing out, I kind of get it. It's just, it's fear of like losing your job or getting a crappy bonus or whatever. But if you don't have to be invested, and the only reason that the best reason that you have for being invested is just the fact that you're watching this thing go up, that's not FOMO, that's just envy. And it's just, you really have to understand you really have to understand your emotional makeup if that's the case. And that's what puts us right now at what I see as a crossroads. Excuse me.
Yeah, one of the interesting narratives that I've heard a number of these quant guys talking about is this idea that a lot of these traders that were forced out of the market are not actually buying aggressively the market through buying of equities, but they're using derivatives as rentals to participate on the upside, particularly using a large amount of options to get that exposure to the upside. And that makes me makes me think that while there's this chasing the markets, not everyone's convinced that this is the real deal. And I wonder whether or not what is the implication of that on the other side once this kind of peters out and runs momentum. Now you have this chart here that you wanted to of the S&P 500. Why don't you tell us what's on your mind on that and how you see this kind of playing out this way?
Well, I mean, to me, what this is saying is, okay, so we had what really was, a broader trading range, and the market was well supported at 2,600 and sort of ran into resistance, originally at 2,900, but then bounced off of 2,800, let's say, in the fourth quarter a couple different times. And then we broke that 2,600 support. All hell broke loose. The guys couldn't buy the G.I. Joes with the Kung Fu grip for their kids at Christmas time. And, I'll leave that to Eddie Murphy. He does it better than me. But that's...
They're thinking, hey, we're losing all our damn money, and Christmas is around the corner, and I ain't going to have no money to buy my son the G.I. Joe with the Kung Fu grip. Okay, and my wife ain't gonna make love to me because I ain't got no money, right? So they sitting there and they panicking, they screaming, sell, sell, because they don't want to lose all their money, right? They out there panicking right now. I can feel it.
To me, that is still the best explanation for year-end market dynamics. I used that multiple times because to me that was the best explanation of what happened in December. Was just people running for the exits because you didn't want to be the one schmo holding stocks. But now you're really at the crossroads again. We're at 2,800, and yes, they managed to shove the thing up above 2,800 today. I think there's some seasonality to it. First of the month, is there really money flowing in? They always say there is. So I'll give them the benefit of the doubt and say there was money flowing in. But if the reason for the rally was really just that a set of China numbers that were crappy yesterday all of a sudden look good today, which were exactly the same numbers, they just seem they're by different sources. So I don't trust anything really. That was more just it's the first of the month. We're in a market that's rising. Let's go for it. But what you're starting to see is some of the moving averages start to roll over a little bit. On this chart, I included a bunch, and I included the MACD on the bottom. And you can see the shorter term MACDs, the 10-20, have started to roll over a little bit. The longer term MACDs, 2155, which I kind of like. It's a weird set of numbers, but seems to work for me. Those are not quite crossed over, but they're close. The 200-day moving average is rock solid. That's actually probably, barring a big rally, that's going to start to decline because you're going to take out lower numbers and you're going to take out higher numbers, put in lower numbers. That's going to take a while, but you're starting to see the 100-day moving average reflect that. That's the red line. And so that's why this is a very tricky time. And going back to what we're saying with vol is, it's tough to make a case one way or the other. Let's go long or short. I think from a technical point of view, from a movement point of view, gosh, we've come a long way in a short period of time. And I'm less thrilled that every time various market commentators have said, well, we're off to our best start since 1987. Well, guess what? That's when I started trading, and that did not have a pleasant end to it.
I know, that's hilarious, isn't it? When they start mentioning 1987 and they think this is a good thing. I'm like, Jesus Christ! Like, don't you realize that what happened later?
Do you have no historical context whatsoever? Best start since 1929.
So Steve, what I was just going to show is last week's show. I went back to 2016 because when we look at market breadth indicators, the last time we saw the market so overbought in a short period of time was the Jamie Dimon bottom in 2016 that saw that big, huge rally that ensued. And I always like to highlight what happened in the next 2 months. Nothing.
Oh, yeah.
Right, like it just traded sideways, and I'm just curious as to whether or not you subscribe to that view. Do you think that there's that this is just going to muddle here, like neither sell off nor rally, or is there another big move coming in the next month or two?
Steve, you're welcome to tell Patrick he's full of shit.
Well, you know what? I would if I disagreed with him, but this is the second time we're generally in agreement, and I actually think
great minds think alike, by the way, right?
Is consolidate. Sorry.
Great minds think alike.
But fools seldom differ.
Absolutely. No. So what I'm thinking now is, let's put it this way: if it would be much healthier if we did consolidate and move sideways for a while. If we don't, I think that just makes it that much scarier because, look at the moves we've had, and I think markets are not healthy when they go in one direction. You need to consolidate. I'll use the old trees don't grow to the sky, whatever. But I can come up with plenty of those. But you need to move sideways periodically just to consolidate these super sharp moves that we've had.
So I have actually something I want to bring up that's just kind of batshit crazy. And Patrick, bring up your trading charts there and type in SPLV. And this is an ETF that is supposedly the low vol S&P 500. So the stocks that are the low volatility of the S&P 500.
So, but they measure low volatility by beta, right? So it's a basket of the low beta stocks.
So just have a look at what people have chased. And right. I tweeted out the other day the different factors that have done best. And one of the best factors since the year to date was actually sell-side analyst ratings. So people are chasing whatever it is that sell-side analysts say. And it was interesting because momentum was terrible. Value was terrible. Like there's been a definite change. This rally has not been kind of just
certainly
more
it's
of
not
the
the
same.
FANG stocks that are running this. I mean,
it's kind of strange,
right? But by the way, I just what I did here, I just plugged in the holdings of this SPLV, and take a look at the largest weightings, right?
It's not Apple,
Exelon,
it's not
Garmin, Coca-Cola, and that's weird because Coca-Cola has not been going up. Duke
Energy. But that's not okay. But these are low vol. I guess you're right. You're saying why isn't it going up?
Yeah,
but it's just kind of. Go back to the chart though. It's a new highs.
Yeah, that's crazy.
Isn't at new highs? This is at new highs. It's kind of it's actually a really interesting point in time. And to Steve's point, it's kind of left a lot of people scratching their heads. And I think that is the feeling that's kind of overwhelming.
But isn't
everyone.
this interesting?
But
look at this one. This is the MTUM, which is the momentum factor ETF, which is in my mind the reciprocal of the low vol. It's supposed to be all of these high beta names, and look, it's trading like the S&P. So arguably the low vol has been what's been driving this.
And to me, sorry, go ahead, Steve.
There's also an index construction thing in here too, because at this point the market cap weighting of the so-called momentum names, think of your FANGs and et cetera, their market cap is so enormous that they more or less are a bigger component of the S&P. Without being able to do the numbers right now, I wonder what the market cap of the stocks in MTUM versus the market cap of the stocks in SPLV is. I would venture to say that you've got the things that led us in 2017, 2018, the FANGs, whatever you want to call them. They haven't been the market leaders. I will say that's probably not a bad thing, because what it means, one of the bullish arguments right now is that the advanced decline line is looking really solid, and that's because people are broadening out away from the stuff that worked so well, the narrow list of winners. I do feel it's much healthier for a market when you get away from the Nifty 50 mentality or whatever you want to call it. The smaller the list of market leaders, the worse it is. So
That's right. We had the Nifty 5 before with the FANG or whatever. And if you look, Steve, one of the things is if you pull up the equal weighted index, which is RSP, if you want to pull that one up, Patrick, that's outperformed the S&P 500. So which would argue that even though we're all kind of in agreement thinking that the next move is down or sideways, you might, if you kind of just close your eyes and we're forced to really think about this.
Come on, Ken. Stop drinking the Kool-Aid.
No, listen, I think the next 100 points is down as well. But there's an argument to be made that the both the advanced decline, the fact that we're broadening out and we're getting equal weighted indexes outperforming kind of the market cap index, it's actually a healthier rally than in the past. Would you not agree, Steve?
I have to agree with that. That to me is the single best feature of the rally that we're seeing is the breadth, is the fact that it's just there's so many stocks participating, and it's not the same old ones that are, that people are looking for value. Whether or not we'll see how that that turns out. But at least I like the fact that people are trying.
I'm going to completely disagree with both of you because to me, the single most important thing of a bear market rally is it has to be so convincing that it fools everyone to get back in. And the stuff that we're seeing right now is just, I think, just the way that this bear market rally is drawing everyone back into the market.
It's sucking everybody in, eh, Patrick? It's like giving people a little taste.
Rug out from underneath them there. That's
give them a little taste. Give them a little taste. Try it out once. That's what you're saying.
Anyway,
I like it.
So Steve, you shared this chart with us over here. So what's on your mind here?
This is extraordinarily confusing. I apologize for anybody who's looking at it. But what I tried to, one of the things you heard the end of last year was people really started, all of a sudden people started to worry about the quantitative tightening, the Fed balance sheet rolling off. And, basically I said, all right, wait a minute, how much of the decline in the markets can be attributed to the fact, to the balance sheet runoff? So I basically plotted the weekly change in the Fed balance sheet and to see if there was anything you could draw from it. And the short answer was, I can't. I don't think you can. Yes, people were focused as the market went down, that there were these drawdowns in the Fed balance sheet, but the drawdowns happened while the market was rising, let's say from March through September. And so what you're seeing here is just basically it's noise, and it's definitely in the back. It's definitely in the background. It's in the backdrop. But I wish I could. I thought I had this great smoking gun, but boy, there's nothing there. And so in a sense,
so Steve, we actually had a fellow on Barton _options, a great Twitter follow for people that are interested, and he went through this, and it's actually you're right that this is no easy kind of panacea that you can put one versus the other and it's going to work. And he went through all the different reasons, and one of the reasons is the fact that there's this TGA account, Treasury General Account, where the quantitative easing quantitative tightening is overwhelmed by the creation or the enlarging or decreasing of this account. And I completely agree with you that it's not as simple as just looking at when the quantitative tightening comes off or when the Fed's balance sheet goes down. That means that the stocks are going to go down. There's no doubt about it. And I encourage everybody, if you missed that episode, go back and listen to it, and make sure you give Barton a follow, because he goes through it. It's much, much more complicated than just looking at the Fed's balance sheet. There's a lot there's a lot of kind of moving parts to that equation.
So actually, if you can go to the next chart and you can see it a bit more clearly, I did a correlation. This is actually the for the quant geeks among us, the top, the graph on the top, the scattergram, is basically the trying to do a linear regression with a correlation of the weekly percentage change in the S&P versus the weekly percentage change in the Fed balance sheet. And you can see that is basically almost as random gets. The correlation is essentially zero. The scattergram is all over. It's truly scattered. And you can see the bottom left, the Fed balance sheet versus that's probably a different way of looking at it than I had where I broke out the movements. But you can see the Fed balance sheet decreasing and the S&P kind of doing its thing. And the reason I want to bring that up is not only necessarily the technical factors behind it, which can better be explained by someone other than me, but what you're going to get a lot of in the next Fed meeting is, what are they going to do with the balance sheet reduction? Are they going to reduce it? Basically, that's noise, is what this is telling me. The Fed is not, they're not overtly behind you the way that they were a tailwind, let's say, from 2008 through the better part of 2017, 2018. But the headwind is not nearly as strong as you'd think, because the market's been able to. The market focuses on the headwind when it wants to, when it's going down, but it can easily go up and ignore it. And so if the Fed, I wouldn't pay too much attention, although the market seems poised to pay attention to it. But at the next Fed meeting, when they start to talk about the balance sheet roll off, it's background noise. I wish I could say it wasn't, because I'm a big believer in don't fight the Fed, but there's no correlation here.
Speaking of the Fed, do you earlier in our episode, you mentioned the fact that you thought that we wouldn't go back to the kind of Yellen era of an easy Fed and lots of fiscal stimulus, and I didn't bring it up at the time, but I wanted to interject and say, aren't we there now with with Powell's recent flip-flopping? And the fact that Trump is running one of the loosest fiscal kind of policies at this stage of the business cycle that we've ever seen. I look at it, and I'm saying that there's no surprise the stock market's going up. We're running kind of balls to the wall, kind of easy, at least on a relative basis, than we have, any time over the past year and a half.
Well, yeah, because you're starting to, you're still seeing the effects of the fiscal stimulus. That wasn't it may be a one and done thing, but the tax laws persist. So you're seeing the buybacks, you're seeing the dividend increases. That's good for stockholders. It reduces the amount of shares outstanding. One can argue that there's a moral hazard to corporate officers buying back their own shares, but we'll save that. Could take hours. We'll save that for another time, I guess. But what happened was, a couple things. Bernanke and later Yellen made it very clear that the Fed put, this mythical put, was struck very close to whatever the level of the market was. Let's call it in percentage terms, down 3% was sort of where the Fed put was struck, because that was always where the buy the dip sort of started to make sense, 3 to 5%, and that's why you didn't really have any big drawdowns. You changed around February, which is when you had the vol blow up, was also around the time that we got a new Fed chairman. One thing that tends to be historically true is Fed chairmen get tested. You never really know how, you never really know when. And Powell got tested sort of as the changeover in February, but then I would say he got his first full test in December. And it was pretty clear that the market had no idea where or if that Fed put was struck. And
right.
It wasn't
Agreed.
until he. Sorry,
I completely agree with you. Yep.
Yep. And so great minds continuing to think alike. And so the problem was, then he basically exercised the put, let's say last Christmas when he flip-flopped. And I think now people have decided, wait, the Fed put's back in place, all clear. And I do think that's the biggest influence behind, in many ways, the level of the VIX. Why do I need to buy protection if the Fed's going to do it for me? Yeah. And as a result,
So Steve, I have a question for you. Sorry to interrupt. So no, I am 100% in your camp. This is my question. So when Powell came, it seemed clear to me that he wanted to change the price of the Fed put. He made all sorts of speeches about being more interested in Main Street than Wall Street. And it really felt to me like he was trying to, tighten financial conditions. Because in my mind, I think he looked at the 2008 crisis and he said the damage that was created by letting, our economy run too hot and then having this crash in the financial markets was really large. So above all else, what I need to do is I need to stop that bubble from occurring. And I think he came and with all sorts of hope that he could basically make a short call. Like he could make, instead of a Fed put, he could make a Fed call, meaning that as it rallied, he stopped it. He increased, he kind of tightened on policy. And I think that's why, when he said his infamous kind of we're a long way from neutral, was at that time, credit spreads were were loosening, and it was really, things were running, and he was trying to stop it. And I'm kind of shocked at how quickly he gave up on that, and how quickly he kind of went back to the Bernanke / Yellen kind of Fed put of that whole kind of concept of we got to protect the markets. And my question to you is, A, do you believe that he was trying to keep financial conditions reined in? And B, do you think that will return?
Yes, and somewhat. I do think that I think that thesis is valid. I think that's very consistent with what he was saying, and I think ultimately that's why if we start to see the rocket ship in the equity markets and credit spreads basically showing no fear and anything, and all sorts of financial shenanigans starting to rear their heads again. I think that's when you start to get. I think he is of the old school where central banker's job is to take away the punch bowl just as the party gets fun, and I do think he's got a bit of that in him. I think that Bernanke and Yellen had that in them too, but they saw a world where risk outweighed reward. And I think that Powell sees a world right now where risk and reward are more in equilibrium than they were, and there are certainly pressures globally, outside of North America that are very worrisome. And so I think they want to avoid getting too far ahead of themselves before they have to really jam on the brakes.
Right. All right. Well, I think that was great. But Steve, what we wanted you to do, in addition to telling us a great story about the markets here, is we wanted to get out of you tales from the trading desk. And you obviously have been in this business for a while, and I have to think that you got a pretty good story to share with us. So, tell us a great story.
Well, I was trying to think back. There's a lot of them, but I'm reminded basically in 1990. So this was when we bounced off of the crash, but there was sort of like an echo, let's say, after the Fed eased. And at that point, I don't even remember at that point, was it Shearson, Lehman, Hutton, American Express? I kept getting new business cards, on sort of an every 6-month basis because we would change the name of the firm. And it was a fascinating place to be because it was the different merged elements hated each other. And so the equity, the listed desk and the over-the-counter desk would not speak to each other. They were mortal enemies. And I was hired with a team. I started my career at Solomon Brothers, and they hired us. They gave us a lot of money at the time, I guess, not as much as everybody thought we were getting, but that was part of the problem. And they hired the foreign equity department from Solomon Brothers, which I was a part of. And we, by the nature of that business, ADRs trade on all exchanges, so we would trade listed and over-the-counter stocks. So everybody hated us, and I refer to the over-the-counter department as one of the great original over-the-counter crime families. And that's really how the NASDAQ was run in those days. It was very much old school guys. It was who you drank with. It was, you get the phone calls. Why the fuck did you tighten the spread, you asshole? Those kind of fun days. I have an order. Well, I don't give a fuck if you have the order. Well, sorry, fuck you. Yeah, just curse back at him. And literally one of the business strategies was from the head of the department was go to as many of these conventions around the country, security traders of Philadelphia. My beat was Montreal and Toronto. Go to these things and try to get in as many pictures in Trader Magazine as you could. This was the business strategy to getting yourself out there. And so, we're one of the things that was in my bailiwick at that point. At that point, there were Nick High warrants, Nick High put warrants that traded on the NX, and one of the knocks on them was they seemed very overpriced. But when the market started to hit the fan a little bit, and these started to get to be, in the money options, I realized this was the way we can more or less hedge the desk. And the head of the over-the-counter department, basically put out the edict one day. I want none of you fuckers to be long more than $250,000 in your books. Okay, fine. I get that. It was actually a good market call because the market the next day basically plunged. But I was long, probably $500,000, probably almost $1 million worth of Nick High put warrants, which to anybody who understands options and warrants, that means you're actually short. Well, so he comes out the next day, the markets are way down. The nature of that business is your long inventory, so it's a bad day. And he's going around the room looking at everybody's books. What are you long? He gets in my face. It's like, I thought I told you no one was going to be long more than $250,000. You're long like $1 million. Like, yeah, yes, but I don't want to hear any buts from you. How much are you down? I said, I think I'm up about $100,000 or something right now. This is one of the best days I've ever had. What the fuck? How are you telling me you have some fucking magic product that goes up when the markets go down? And I'm like, yes. What are you doing about it? I'm like, why are you yelling at me? I can't do anything about it. I'll try to trade out of them and then lock in a profit. And he just basically skulked back to his office. And I realized, you know what? You really have to understand your strategy and your product. And later on, that was a hell of a lesson to me. It was like, oh my God, I'm working for a fucking moron. And I did leave. I did leave shortly after that. But basically, the other part of the problem was it was such a dysfunctional place. At one point, the guy who during the steel cage death match between the head of the over-the-counter department and the head of the listed department, the head of the over-the-counter department, the one who I explained about magic products to, won the power struggle. And there was an all-time sales trader. So they were bringing it, they brought one. They then told one of the other guy's deputies, who was in Disney World, that he was going to be running the listed area. So the guy cuts his vacation short, comes back from Disney World. Along the way, they changed their mind and fired, and comes back to think he's taking a promotion. He gets fired too. So there's another old line guy, Victor, and he's walking around going, "Give me an ass to kiss. I just put an ass in my face. I'll kiss it. I don't even know whose ass to kiss. Give me an ass to kiss. Got an ass out there? I'll kiss it." I'm like, holy crap! I got to get the fuck out of here. But that was some lunacy back then.
Those days. That's the Wolf of Wall Street days, right? Like that's.
Wolf of Wall Street was actually more recent than that. But that is just awesome, Steve. Like that is hilarious. You know what I think is funny is that people don't realize how often your boss is just completely out of touch. Like as a trader. We always used to just cringe when the boss would come and make us tap us out of a position because we would always put it into our PAs at that point because at that point that it's going like their timing is terrible. They don't have a clue what they're doing. They're just reacting. And I just think that is the funniest story ever. Like that is how it used to be. I completely agree with you. It's just was madness.
Yeah. That was a specifically dysfunctional group. You know, the best story actually was involved like a friend of mine who was notoriously, he was this fat, you know, disheveled looking guy. Great, he was a great friend, and for whatever reason, this guy was a ladies' man. And his wife one day, you know, one of my friends was in, you know, I actually had then moved to trading equity-linked products, considering that I understood these magic products. I then became head of that area. And so I was trading these equity-linked products called primes and scores, which were then outlawed by the IRS. And literally the guy who invented them did nothing but sit in his office and tap a globe against the wall, because we called him Globe Guy, because he had this one great idea. The IRS shut it down and eventually took his contract and left. But and so one of the guys, one of the officers comes up and he goes, I let his wife in. I'm like, what the hell do you mean? And it was this, you know, it was a neighbor who worked in the department. Guy's wife is sitting at his desk, going through his drawers and his Rolodex, and everybody's afraid to approach her. I knew her pretty well. I'm like, hi, what are you doing here? And she like reaches into his drawer, pulls out a pair of panties that some woman sent him. So I'm like, oh, this must come in handy. But unfortunately, we had to get her away because she was going through his Rolodex and hitting all the speed dial buttons, you know, like thinking they were mislabeled. You know, it'd be like, oh, this one says Fidelity. I bet you it's some girlfriend. I was like, hello, who is this? It's like, you know, Fidelity. You can't do this. You can't kill our. I don't care what you guys are doing in your home life. You can't kill our business by just hitting every speed dial button and yelling at every woman who answers the phone, because she's probably a buy-side trader that we've been cultivating. Can't do this shit. So it's you know, those days were they were interesting. Let's put it that way. And you know, that eventually ending up in a very quiet, quantitative, austere environment definitely took a little bit of a change from coming from the wild world as it was. I mean, I could go on for a while. There was some nutty stuff back in the day.
My God, Steve, that's the funniest story I've heard in a long time. But
yeah, no, that's
like
that was
really
good.
I don't know if it's the Green Bastard IPA or what.
Yeah, no, it's definitely this is like the Trailer Park Boys quality Green Bastard stuff. I
could just see the guy's wife going through and hitting the lines. Like I could completely picture it in my head. Like, you know, and then you're sitting there cringing as she hits as the clients are picking up, and you're just going, oh my God, we got to get her out of here.
We got to get you out. Can't do this. And meanwhile, you know, my friend, the option trader, I'm like, how did you let her in? He goes, she lives down the street. She waited for me in the driveway and hopped in the back seat in the car with me.
She obviously knew her husband really well.
Oh God! You know what? This guy's a legend. I won't mention his name just because it's not fair. He had the best line ever because, you know, he was a great sales trader. His clients loved him. But, you know, he was a little cavalier with timing, and, you know, and apparently he one time was, you know, time went on, get a big order the next day, but occasionally was a little late to work, and, you know, was calling in late or sick because he had a little too much fun the night before with his clients. And finally, it's like, all right, if you call in sick one more time after being out with clients, I don't give a shit how many tickets you write, you're fired. So the guy calls in, he goes, I can't come in today. And he goes, you better not tell me you're sick. He goes, nope, I'm not sick. I'm fat. I can't fit into any of my suits. I'm too fat. I can't come in today. And the guy was such a guy that everybody loved. The boss who wanted to fire him just like, yeah, okay. I got to give you that one. So damn. Yeah. No one's ever called in fat before.
I think we just found the title of the episode, Patrick. Calling in fat.
That's awesome. All right, listen. You know what? Just for our listeners, Steve agreed to stick around. We'll not only have a chat after the session, but what we wanted to do is move on to what we wanted to talk about is one of the more important things this week, and Steve's going to stay on and kind of give us his opinions when we're talking about this. So let's move on here, and I sort of put together a couple of fun charts here, and really what I wanted to, well, first of all, what came out here today was the GDP numbers in Canada. the monthly GDP numbers, and it once again came in negative on a month-over-month basis. And what's interesting is we had 3 out of 4 negative months in Canada, which in itself is not a recession yet. And I mean, it's just negative GDP. We've had them in the past in 2015 and a few other places when the oil was rolling over. But what was interesting is that this is happening in Canada the same time as we are seeing, and this is the Atlanta Fed GDP Now number, and you can see that the blue chip consensus is still GDP just under 2%, but the Atlanta Fed now has a GDP number under 0.5% on their first quarter forecast, which is really a surprise slowdown in anticipation, because obviously we just had a little bit higher than expected GDP print just earlier, and so there's this idea that the economies are slowing, both in Canada and the U.S. And the question I wanted to ask both of you is this next chart. So this chart came from Pring.com. And what they showed here is that during secular bull markets, and this is these kind of 20-year secular bull market scenarios, there are these multiple short-term mild recessions or slowdowns before the continuation of the bull market, or is it the turn for one of the red recessions? Now, the argument here for the bulls is that this is just a slowdown. The slowdown is going to be brushed off, and we're going to go surging, and there's a couple more years left in this bull market. Versus those that are, and I have to admit openly that I'm more in the camp that I believe that the business cycle is turning and that we're going to go into a deeper recession. But I wanted to sort of get both of your thoughts on the GDP. And whether or not this is really a more meaningful turn, or whether this is just a modest slowdown. Why don't we start with you, Steve?
Well, looking at this chart, something really jumps out at me. You get eventually you run out of the number of slowdowns that you can have. We had 5. In the first green box, we had 5. Three
that's the 1960s, 50s, and 60s, yeah.
Exactly, which is almost ancient history at this point. And as we start to get into the 80s, and we're back into the 1 mile recession, 3 slowdowns, and you look and you had like this little gasp after the 3rd or 4th rally, and then that's about it. Considering that we're into a bull market that's what is it now, the 2nd longest in history, and
from an equity perspective, it's supposedly the longest. But it's interesting. This secular bull market chart is trying to imply 20-year bull markets. But from my perspective, the measurement of this bull market is from the 2007-2008 low, which makes this about a 10-year bull market, right? And from that metrics, in my mind anyway, it's one of the longest in history. But anyway, go on.
No, so to me, I'm looking at this going, all right, you get, there was an old saying, 3 steps in a stumble, which related to the Fed which related to Fed rate increases. You get 3 upticks and then a downtick. We well blew through that this cycle, but I wonder maybe the 3 steps in the stumble really applies more to 3 slowdowns or 3 recessions in a stumble. And, you're certainly not going to get more if this really is as dire as the Atlanta Fed says. And I've got my thoughts as to why it might be. Maybe that just means we're sort of getting closer to the end than we're certainly closer to the end than the beginning. The question is, when is the end? And maybe that means you get a little bit of a gasp afterwards, and then
So, Steve, you listen. You understand that as the unfolding reality emerges, we all have the right to change our minds along the way. But on a balance of probabilities, are you concerned that this is the very key top, and that we're going into a more meaningful, deeper market contraction, or do you think that this is just a slowdown?
I think right now it's a slowdown because I still think you have all this fiscal stimulus to play out. And, you know, that to me is the one thing that makes me think that we're not going to necessarily go right to hell. The thing that can really derail that is the rest of the world. If China is really meaningfully slowing down, and yesterday the numbers made it look like it was, and then today the numbers made it look like it wasn't. But if China is meaningfully slowing down, and Europe, which really can't get out of its own way, don't start to improve, that just continues to weigh. We don't even know what Brexit's going to do to Europe. And so, you know, a friend of mine who retired from managing a global bond portfolio, you know, I see him periodically, and you know, he said he was expressing a fairly bearish outlook to me, and his rationale is the number of negative yielding bonds in the universe that he used to trade, and the fact that Europe just cannot even maintain anything resembling a positive interest rate, let alone real recovery, really makes you wonder. You know, North America's sort of, you know, been immune from a lot of the rest of the world, but does the rest of the world sort of drag us back down into the swamp with them?
Right. Well, what's your opinion, Kev? What would you push?
Okay.
Would you push back on him on this, or?
Well, no, I wouldn't push back on Steve, but you, Patrick, I would push back on.
All right.
Oh, thank
so
you,
let's
Kevin.
Let's start with the GDP now.
Right.
Like the fact that you bring this up and as some sort of sign that therefore we should think that the recession is coming. Have you ever followed this indicator?
Yeah,
This thing is like a rat on acid. Like it's nuts in terms of how much it's all over the place. And maybe, you know, a smart listener can, you know, tell me how this is such a great indicator. But to me, it's something that Zero Hedge pulls out when he wants to figure out like some negative argument about what the disaster that's coming. I don't give this thing any credence whatsoever. And I'm open, like I'm always trying to be open-minded to new ideas, and if someone can prove to me that this GDP now is a reliable indicator that I should watch, then by all means, please send it to me. But you know, apart from that, I'm just going to ignore it.
But
so let's just put that to side.
Stop for 1 second then. But because also Goldman Sachs launched its Q1 GDP number, and it's under 1%.
Okay, so if Goldman tells you something,
you do the opposite.
That means they're getting their book ready to go the other way. So I'm not trying to argue that we're going higher in terms of our economy, and I just think that this is no way to argue it.
Okay.
So that's the first thing I'll say.
The one take. Go ahead. I'm sorry.
No, you go ahead, Steve.
Well, the one takeaway here is, are we talking recession or slowdown? Because recession, if you're going to define it as two negative quarterly GDP prints, which is the sort of the dictionary definition, it's going to take a lot for that to happen with the fiscal backdrop that we're seeing. So that's why I'm a little. I don't want to go out there and say we're going to see a recession right now. Now you might see an earnings recession because, you know, I think companies have squeezed that grapefruit pretty much as much as they can do. But in terms of the broader economies printing two negative quarters back to back, you know, it's going to take a lot to do that. You know, yes, we've got, let's say in Canada, 3 out of 4 negative months. But that's still quite a ways from 2 negative calendar quarters.
So Steve, just so you know, I have a poor track record to date against Kev on this because we made a steak dinner bet back last year that we were going to be in a recession by the end of last year, and I had to pay due on this just recently.
It was a tasty steak from Harbor 60, I must say.
It was, and so I lost this bet. But my thesis remains, and I just want to be on record for this, is that, when you're looking at U.S. stimulus and you're looking at all of the reasons in the U.S. as to why the GDP will weaken in the U.S., I think you're looking at the wrong thing, because I continue to believe that the global economic recession will happen much quicker than it will happen in the U.S. And I think the global world economy is going to grab the U.S. economy by the heels and drag it down. And I don't think it's going to be about U.S. data or the way the U.S. economy is functioning, but rather a global slowdown. It'll be almost the reciprocal of 2007, 2008. Maybe I'll be proven a fool for that theory, but that's my stance on that.
Well, that jives with what my friend, the bond portfolio manager, was saying. Basically, is that the rest of the world, we can't escape the rest of the world. Right. That Europe and Asia just things are moving so slowly, you can't just pretend they're not. The other thing that I think is really the biggest wild card from the U.S. point of view is what happens during tax season. You've got the tax refunds, are one of the most bizarre situations that you get economically, right? Because basically you've essentially overpaid the federal government all year long in the hopes that sometime, in March or April, when you get around to doing your taxes, they're going to then give you back your money, and you get this windfall of money, which is essentially just forced savings without interest rate. The problem is, for many people, if you're a middle income wage earner who is not a big saver, that's the biggest check you get all year. And so you've got a lot of people. If you watch the ads very carefully, you see things like, spend your tax, you can spend your tax refund check here, or H&R Block will lend you the money against your tax refund so you can go out and buy something. And the problem is the withholding tables changed as part of the tax reform. So effectively, you were giving people maybe an extra $20, $25 a paycheck for the course of the year. That averages out to $1,000. Well, guess what? That means that most of the people would have spent those $20, $25 a year. They wouldn't have said, "Ooh, this is this windfall I'm getting. I'm gonna go spend the money," and that money's been spent. And guess what? Now when you've been hoping for your tax refund to get a new washing machine or fix your roof or make a major purchase,
it's going to be a smaller check.
Be there.
Wow.
Smaller check, or depending on which state you live in, because they changed the state and local tax deduction. I live in Connecticut. I don't even want to know what my taxes are going to do, because you can't deduct. You can no longer. You're capped at $10,000 on your state income tax, on your property taxes. So you're going to find people of all stripes in high tax states, which is basically both coasts and a bit of the middle, Illinois, basically. You're going to find those people not only not getting big refunds, but they're going to have to write checks depending on where they live.
Wow.
So Steve, would you
believe that's really going to have a negative impact on consumer sentiment?
So Steve, would you argue that the seasonality that we would see previously will be kind of turned on its head because of the change in the tax policy?
I think it's possible. Now, right now they're being very cagey. First they're saying, government, refunds are down 17%. And then if the government, well, it was because the government shut down. So maybe it's not that. I got to think that will weigh on consumer sentiment in a bad way. And yeah, I think there is a certain seasonality. I think certain major purchases that get made at this time of year that people have conditioned themselves to do, they're going to have a harder time doing it. And it's money is fungible, but you can't spend what's already been spent.
Wow.
Yeah. So Patrick.
Yeah.
After I gave you all that hassle about your GDP now, I'm actually in your camp, right?
Oh my God! Now look at the flip flop coming.
Yeah, no.
Oh
so
my
I'm
God.
as bad as Powell, but ultimately, I just kind of felt like it was my duty to give you.
Okay.
Time. And I'm gonna tell you why I think ultimately that we're gonna have. I listened to Steve, and to me, that's just another kind of nail in the coffin. And one of the issues that I think is really important that not enough people are realizing is this issue with the corporate bond market. And Many people will talk about the kind of the deterioration of credit quality, and they'll talk about the fact that if you look at investment grade bonds, we are now at a point where there is more triple B bonds within investment grade than we've ever had. And kind of the end of the world doomsdayers.
Does not the triple B market now dwarf all of the higher rated tranches combined?
I have no idea, Patrick. I'm like,
you know, I remember looking at
a
chart. I remember looking at a chart and just looking how huge that triple B tranche is relative to everything else. It's bigger than the entire.
I do know this for sure. There's
market,
never been more
and
triple Bs than there are now within investment grade.
Just as
so
big
the point is,
as the rest
and this
of the
is this is not my idea. I'm not smart enough to come up with this, but I was at dinner the other night and I listened to.
But it's big.
Yeah, so. I was listening to Rosenberg, David Rosenberg, the guy that everyone gives a hard time about being a perma bear. I actually don't find him a perma bear, and there were times that he got somewhat bullish. So I don't see why people say this. But anyways, his point, and when he said this, a light bulb went off in my mind. He said, everyone's excited and worried about this triple B kind of, the increase in the amount of triple Bs. And everyone's thinking that you should go out and short, investment grade bonds. And I thought about you, Patrick, because that's something that you would definitely be doing.
Oh, I'm totally doing that.
Yeah. So he said, that's not the trade. Think about if you're a CEO or a treasurer of a company that is on at the triple B and is at the kind of the verge of being, relegated to the junk status. What will you do to protect that triple B rating? You'll cut back on buybacks.
Like grim death.
Yeah,
you're going to hang on to it like grim death.
I completely agree, Steve. You'll cut back on buybacks. You'll cut back on CapEx. You'll do everything you can to make sure you don't go to junk. Because if you go to junk, the cost to refund your credit, like the bonds outstanding, will go through the roof.
Yeah, well, so you're just validating the fact that we're going to roll over here. How the hell do we have another leg in this chart on the upside if you're right about that?
Yeah, no, I agree. That's why I was giving you a hard time. Ultimately, I think when I think about that, the corporate side is going to be spending less, and then I think about Steve's argument about the consumer, and it seems to me that the economy in the U.S. is going to finally roll over. It's difficult to get excited about it. Like that's how I look at it. Yeah. And even if the fiscal, there is some arguments that the fiscal is still, the amount of Trump stimulus and that tax cut it might not be complete, but there's no doubt we're getting closer to the end. And being 10 years or 9 years or whatever we are into the one of the longest expansions we've ever seen, it just feels to me that, maybe we go higher, over the short run as everyone chases it. And it's that point where everyone gives up when Patrick finally says, you know what, the squiggles have made it so that I'm bullish now because we've, Steve, you don't know this, but that Patrick sometimes does the ultimate technical analysis kind of sin in my mind. He says, well, if it goes up, I like it. And if it goes down, I hate it.
Oh, Jesus. Oh, my God. You know what? This to be continued because you are impossible. The fact is that I'm going to drop it. I'm not even going to go here. I'm not going to go here. You win. Fine. All right. Listen. Okay. Let's stop here. Listen. What we're going to do for all of our listeners, Steve's going to join us here. We're going to now roll forward and continue on with the show. But if you want to hear more from Steve, stick around for the end of the podcast, and we'll hear more from Steve.
But before we do that, Steve, do you have anything you want to plug in terms of way to see you or anything of that nature?
Well, the best way to keep in touch with what I'm doing, I'm not the biggest Twitter and LinkedIn person, but I do post periodically. What I think the best way to stay on top of what I'm doing is I put a lot of stuff out on the Interactive Brokers Trader Insight page. Not always the easiest to find, unfortunately, but if you go to the Interactive Brokers website and then click on Education and Traders Insight, you get to see my smiling face and see what I'm saying on basically posting stuff on there most days a week, usually short videos or short articles. But I'd love if you checked it out and wanted to, check in with what I had to say.
Oh,
Well, that's great, Steve. What we'll do is we'll include a link in our email that goes out to everybody so that they can find that more easily. I, as an Interactive
Terrific.
Broker, customer, I can attest to the fact that sometimes Interactive Broker, although a great firm that I love, is a little difficult to navigate various sections. It's kind of one of those things that they love. It's made by computer geeks, I think, at times.
yes. Yes.
Yeah.
All right.
I know
Anyway,
you're not allowed to say anything bad about them.
All
But
right.
anyways, we
I
love
can't say
Interactive.
anything bad, but you're,
Yeah, we love Interactive Brokers, and we'll include that link in the show notes.
all right. Perfect. Thank you.
thanks.
Kev, it's time for This Week in Trading History, and I wanted to give you a blast from the past, going back to the Great Depression, and more importantly, a term that we've all heard used before, but it's amazing that it goes all the way back to 1932. Actually, in the intro, I said 1933. It shows you how on the ball I was, but Glass-Steagall. It was passed on February 27th, 1932. And so just to give a quick lesson to our listeners what that was all about. It was originally passed to protect depositors. It was passed by Henry Steagall and Carter Glass, the senator and the representative that put it into law. And basically, the whole thing was to kind of find a way to lend to distressed banks back then, because all these banks were essentially going out of business back then during the Great Depression. And they wanted to get the Fed lending to these banks, but they had to put a firewall in. And at that time, they created a law that basically prevented commercial and investment banks from being linked, and forced the banks to basically be split apart there. And that was a pretty big deal back then, because they wanted to create these sound money center banks that were not investing the bank capital into risky speculative investments, right? And they came to law. But wasn't it interesting that that the financial crisis, going almost 70 years later, was very much driven by the fact that this was repealed, right?
Yeah, so that's the point that I want to bring up is on November 12th, 1999, President Clinton repeals Glass-Steagall.
Democrats.
No,
just kidding.
Yeah, there we go. Typical Patrick going on about the Democrats again. They're the source of all evil. No, it's actually the liberals, don't you think? Anyways, I think that you have to think for 67 years this worked, and then they decided that this legislation that had worked, that had kept the banks sound, should be repealed. And I really think that repealing of the act was one of the reasons that we had such an ugly 2008 crisis. And I look back to the repealing of this Glass-Steagall Act as one of the biggest mistakes that has ever been done. And I know Dodd-Frank is attempted to try to fix some of these issues, but I think that the Glass-Steagall was a much better way to doing it. Just separate banking from kind of speculative activities. Like, I just don't see why they should be together. And I know the arguments that they have to compete on a global stage and stuff, but I see too often, in terms of in Canada, the brokers just holding companies hostage by giving them loans that are tied to underwriting, the equity portion of their business.
Right.
And I think we'd be much better off with these two kind of functions being completely separated. Yeah.
Yeah.
So,
well, money center banks, have the responsibility to one degree or another in facilitating the creation and movement of credit. Right, it's a very important role in keeping a proper capitalist economy running, and their ability to create credit. I think there is always a slight conflict of interest when they're also facilitating the investment banking side of it at the same time. I do understand the principle of keeping them separate. I don't, and it worked before, and you can see how well this has worked out for Deutsche Bank in terms of and other is like that. And obviously what happened in 2007, 2008, right?
Yeah. So there you go. You have to mention Deutsche Bank again because you know that was one of my recommendations.
Well, listen, you've come around. You've come around.
One of my things.
What else do I have to say?
Yeah, fair enough.
I can't hold it against you. You've already conceded on this one. So
that's right. Okay, let's move on to the next.
Yeah, let's move on. Kevin, time for the WTF clip of the week. What do you have in store for us this week?
Well, Yellen was in the news. She just can't keep her mouth shut and kind of fade off into the distance. And she said something to the effect that she thought that Trump didn't really understand monetary policy. So I thought it would make a great WTF clip of the week. Recently, Powell was asked about this, and let's just play the tape.
Let's play the tape. Let's see what happens.
Thank you. Thank you again for being here, Chairman Powell. Yesterday, your predecessor, Janet Yellen, said she doesn't think President Trump has a grasp of macroeconomic policy. Is she right?
And I want to look him straight in the eye, and I want to tell him what a cheap, lying, no-good, rotten, four-flushing, low-life, snake-licking, dirt-eating, inbred, overstuffed, ignorant, blood-sucking, dog-kissing, brainless, dickless, hopeless, heartless, fat-ass, bug-eyed, stiff-legged, spotty-lipped, worm-headed sack of monkey shit he is.
I won't have any comment on that for you, Senator.
All right, guess I'm not surprised.
Wow. All right. You know what, Powell? He took this very safe choice.
Yeah, he wisely stepped aside and did not answer that question. And you know what? He's probably smart to not answer the question because last thing he wants is Trump yelling at him at the next dinner he has to have, right?
Right. We're going to circle back to that one, right?
That's right. That WTF clip that got a little dark. This one was still a little bit more on the up kind of upbeat tempo thing.
Yeah, good job, Kev. Good job.
Yeah, no, I appreciate that. I definitely think that Powell was smart to avoid the whole idea. The question is, what is Yellen thinks that she's accomplishing by saying this? I don't know if she's trying to help Powell out or but to me it doesn't seem to be that helpful. And she should, do what
she's a private citizen now. She can basically say whatever she wants.
Yeah, but the reality is usually what they should do is they go and just earn their $100,000 a speech and kind of milk it without making headlines. And she's still making headlines, which is not what you want to do. And she's kind of stirring a hornet's nest with this, poking her head in there with Powell and Trump. And the last thing that Powell needs is more kind of
more cowbell.
Friction. Yeah, more cowbell. Anyways,
right. Let's move on.
For sure.
Kev, it's finally time for the top 5 things to watch next week. But before we get into the top 5 things to watch next week, let's just circle back and see what was on our mind last week and what we thought of what's going on. And so our number 5 was a gold rally bumping its head on resistance. Now, I was technically talking about the gold level, but interestingly enough, you wrote a little blog piece about gold, and someone decided to call you out on this shit, and kudos to them for doing so. So the tweet was this: as you predicted, your gold article really did top ticket, but you predicted it so
yeah. So that's my buddy Inner_scorecard, a real good guy, and on Twitter. And when I wrote the piece about the gold, central banks and the amount of gold they were buying, I did preface it with the kind of the first sentence was, I've been waiting to write this piece, hoping for a pullback in gold. And the moment I write this, I'm worried that I'm going to top ticket. And to be fair to myself, I did not top ticket.
Oh, come on. What price was it when you wrote it?
I was 4 days early.
Well, so you did it. What?
It did go higher. February 14th. I wrote it on Valentine's Day. It was
okay.
It
So
was a,
that
it was a piece for my sweetheart.
Oh, right here. Okay,
the precious yellow fellow.
Listen, this was the Kevin Muir pop right here.
That's
right.
right.
This little rally was just all you.
Yeah.
Right
so
here.
You think that's true? Do you think I can cause the gold market, $1 billion market? I'm moving it around.
Oh yeah.
Yeah.
Everyone
everyone
picks up on your blog. I mean, the algos were all over this shit.
Yeah, that's right. So I don't think that, but I definitely was pretty close to ticking it. And this is something I've been worried about. There's no doubt I was.
Look.
And I started the blog with that was the first sentence, and I'll link to it in the show notes. But it definitely gold shit the bed like today. It had some trouble.
We marked that high last week's show for a reason, and the reason was that this was a major.
Squiggles.
No, it's an overhead resistance. What do you mean? It's not squiggles. It's a level where even guys like Luke Groman, who don't use technical analysis, talk about the fact that that's the upper boundary. It's more than just technicals. The 1350 has pretty much capped almost all attempts. 1350 to 1400, that kind of $50 area, has more or less capped almost all gold rallies. And one of my big arguments has been that while I am very big picture bullish gold, I didn't feel that this was the environment from where the big kahuna move was coming. And that doesn't mean it won't even happen this year. It could even potentially happen this year. But this throwback in gold is going to be a real big tell, in my opinion. Because if gold goes all the way back down to its previous lows, even just the 2018 lows, around let's say 1180, 1190, that's pretty, it would be disappointing. What would be really impressive here is if somewhere, give or take, in the middle of this range, forget Fibonacci levels, just, if 1250, let's just for round number purposes, was able to hold the line, and this was just nothing but $100 step back in gold after a pretty solid advance, that would be very bullish for me, technically. I think that would mean that it's going to get accumulated on dip, but we're still probably weeks away before something like that can manifest. So I think we're watching. But anyway, back to our top five. The whole point was it's bumping its head on resistance. Was it going to reject? It rejected. End of story. That's done. What I wanted to move on, number 4, we talked about Brazil, right? And guess what? It's not breaking out. You did Hulk smash this thing.
I Hulk smashed it to the
You
negative,
Hulk
right?
smashed the Brazilian index. This again, the Kevin Muir effect. Yeah, did you write a blog about this too? No, you didn't.
No, I didn't. I just brought it up at
I don't. How did the algos pick it up? They're not picking up our show. So
they're scouring the show notes.
But so far it has not been able to break out, and maybe it's a double top. It'll be interesting to see. You know what? In order from a technical perspective, for it to be a double top, it needs to break this kind of this 94,000 level on the Brazilian index. Hasn't done so yet. Let's check up on it next week. But anyway, so far, I'm saying you Hulk smashed it. So let's see what plays out. So the next number 3, we wanted to talk about copper, and one of the things I mentioned was that for me, the real breakout in copper is is a breakout above the round number around $3. And because to me, that was a level that I thought was really important. That's a key Fibonacci level, again, talking squiggles. And in my mind, even though it is pretty much at almost a 6-month high, I want to see it north of 3 before I go bullish. This kind of reflation story that's been kind of going around, I'm not convinced.
So, Patrick, let me get this straight. If it goes up, you want to buy it, and if it goes down, you want to sell it?
Oh, my God. Every episode, you're going to call me out on the shit.
I'm just giving you a hard time.
Hey, you know what?
No,
Hey. Let's stop right now. What do you or do you not appreciate Jesse Livermore and the reminiscences of a stock operator?
Yeah, I love the guy, and if you're comparing yourself to that,
no,
to Jesse Livermore,
but he did.
Then we got some issues.
He did buy when it went higher. All right, and so you are shitting on Jesse when you make that statement. So watch yourself.
Okay, let's move on.
This is too many beers.
That's right.
All right. Anyway, let's go on. So number 2, we had the GDP numbers, which came in a little bit stronger, but we're not talking forecasts. The actual GDP came in at 2.6 or something like that, but the ISM was weaker.
It's still a mixed bag. We're really getting we're getting no kind of clear signals about which way the U.S. wants to go. And we were talking with Steve about that, and it'd be nice if all of a sudden all the numbers was coming one way, but it's all over the map. And one time you get a good one, then today you get a bad one, and it's all over the map. So back to Steve's idea that we're kind of at that kind of treading water, trying to decide which way we want to tilt. It's just more of the same.
Yeah, more of the same. Number 1, Powell testimony. You know what? I think you summed it up best with the WTF video, but is there any additional comment you had on top of that?
He's getting better at saying nothing. Like he's becoming more green Spanish. No, really, honestly, and I said that, I say that kind of somewhat facetiously, but he used to come out and put his foot in his mouth all the time. And at one point, I remember seeing a stat about how many times that when he spoke, the market went down, and it's no longer the case. So he's figuring out this game of being the Fed chairman, of making kind of comments that are not market moving, which is really what he wanted to accomplish, and I think he did that.
Right. All right, well, that was last week, so time for us to update everyone with the top 5 things to watch next week. So number 5, Kev, was I wanted to talk about Korea.
Yeah.
Obviously, the talks with Korea didn't go so well.
Right. Trump went to Vietnam to meet with the North Korean leader, and he had to actually kind of walk away with no agreement, and there was a lot of hope that they'd come up with something. And this is my turn to talk about squiggles. Okay. And I don't.
Go for it.
Here we go.
All right. Let me pull it up. I'm going to pull it up right now.
The Korean index. With the 200-day moving average.
You want me to put a 200-day? Now, you know what? I by default, I think I only have the exponential version of it. You wanted the no, hold on.
There you go. But I think the regular 200.
The regular one is just above it. Okay, hold on a second.
It just ticked right there.
Hold on.
Almost
let me find the simple moving average in here for you. Hold on a second here.
Here we go. Anyways, while you're figuring out your squiggles, I did find it interesting that it bounced right off of that, and it was kind of some bad news. And the market, all the other markets were ripping higher. Like today, I think Japan was flying, China's flying, and yet Korea had a couple of bad days. And the real question
is this bad day?
Yeah,
it was one big bad day.
It's like almost.
It's almost like everyone cares.
Yeah, it's almost like those squiggles work. Anyways, so I think it's an important thing to watch. Korea is actually a very large economy. It's a tell for the global kind of reflation trade.
It's a big and it's funny that it's in the emerging market basket, but it's not considered a developed nation. But arguably, I would argue that in many ways it may be as developed as Canada or something like that. I don't know why they basket it there, but I guess China is also in the EM space, right? Anyway, but the point is it the start of a bigger pullback and it's going to drag the EM space around, or is it a buy and dip?
I don't have an answer for you, but I definitely think it's something you should watch. You should put it on your radar screen.
You know what's funny?
The real question was whether it was just a function of Trump's kind of inability to come up with a kind of agreement with North Korea, or whether it was really a problem that might run a little more deep. And that's what I think you should be asking yourself.
I'll tell you what, we're going to give everyone an update next week, so we'll get an opinion there. You know what? One day doesn't make a new trend. The first impulse I have is to buy the dip on it. But let's see what happens. My first instinct is to fade the sell-off. Number 4, I wanted to talk about bonds, and this kind of I really wanted to pick your brain on this because maybe I'm just too amateur on this, and you're more of a bond guy than I am. But my first impulse is that when we have a lot of weak economic data starting to roll in, or mixed economic data, it presses this idea that inflation is not a big issue. And to me, like the long bond is very much a major pricing variable in there is inflation expectations. Yet in the last 3 days, the 30-year yield, or actually let's start with the 10-year yield, had a big pop. Right?
Yeah.
So we had this pop to 275, but you know what? I think the bond market is the easiest way. Let's look at the 30-year bond and look at this break. We're basically at a new low for 2019.
So Patrick, yeah. So this is the problem with putting all bonds and all maturities into the same bucket. And I know I talk about the yield curve and the 210s or the 530s, but never before has it become more obvious than what's happening right now. So the economy, or so the bond market is selling off because the Fed has signaled they're going to be easier. And I know that seems kind of, why would bonds sell off if the Fed's going to be easier? Because the Fed has indicated that they're more willing to accept inflation going forward. If you think about what a bond investor's worst nightmare is, apart from default, it's inflation. So if you're someone that's sitting there and saying, oh, the Fed's going to be less kind of hawkish and they're going to be less on the ball and willing to raise rates as inflation sticks its nose up, you would say, I'm less inclined to own 30 years. So can you pull up the 530 spread for me?
You bet. So here's your 530s.
So look at that.
58 basis points.
So that's telling you that the spread between the 5s and the 30s
continues
is
to widen.
Actually at the widest it's been in the last while. So pull up the 5-year T-note. Let's look at that over the last little while.
Yeah, sure. So you want the yield or you want the bond?
I don't care, whatever, which
one. So here's your 5-year yield.
So you'll see that it's gone up slightly, but it's gone up very marginal compared to the 30-year. And so what this is telling me is that the reason that the bond market is selling off is because the Fed is being overly easy. And I know that seems crazy.
I'm just, you know what, I understand what you're saying. I just think that's an opportunity. For me, it's the Japanification of the world. I'm just not going to drink this. I think that any time the market starts pricing this in, it's just giving you a better entry. Look, I understand what you're saying. I don't want to say that you're wrong in what you're saying. I just don't think it's going to play out. The risks.
Come on, Patrick. You want to say I'm wrong? Go ahead, say it. But it's okay.
No, because what you're saying is actually what the market is actually pricing in and doing. I just believe that that's offering an opportunity, because I just don't think that the end game will look like that. At least not until we have some crazy monetary change. But anyway, off topic, I wanted to talk about this. This is the 210s. And we're upticking here. Do you think that this is also a steepener starting?
So I've always said that you should own the 530s over the 210s. I don't think
but okay, I know, and you're on record for that. I'm not even going to dispute that. But the question I have for you: do you think that is this just a little uptick or is this a meaningful turn in the 210s?
No, I actually think that
this is just
the
noise.
Fed this should be sold. I think the Fed will be loath to actually lower rates, and they'll be slow. Right. And I can't bring myself to say that we're going to get steepening in the 210s. I can see it much more in the 530s.
All right. Well, you know what? You're on record for that. I'm not going to totally disagree with you. So number 3. Canadian GDP obviously came in negative on a monthly basis. Trudeau is running himself into trouble on the political front, and like it looks like the Canadian economy is slowly grinding to a halt. And I know you try so hard to be bullish Canada against the Aussie, but I tend to be a little more outright negative Canada than you. Not crazy amount, but what's your take on this? Like, was this something big in your mind as to what's happening here? Is your tone changing at all with what you're seeing happening?
No, so first of all, I love the short Australia CAD. That's still a trade that I'll take any day of the week.
All right, let's get an update. Yeah, you're trending lower, and kudos to you. You made a good call so far. So far, I'm not going to shit on you on this one. Overall, it's not a bad trade. But
and I actually think that to some extent, Trudeau, for those that Americans that, or anyone, global listeners that don't realize it, Trudeau has got himself into quite a pickle in terms of. There was a kind of a scandal in terms of bribery of one of our major companies, and it's a Quebec-based company. Listen, it's boring. It's Canadian politics. The long and short of it is that he's gotten himself into some trouble. But I have a question for you, Patrick.
Yeah.
That scandal, does that make the CAD a buy or a sell?
So, okay, when we're saying the CAD, you're talking USD/CAD.
Okay, whatever. Do you buy or sell the loonie? Like, do you buy?
Oh, listen, like, I'm a bear. I'm a bear on the Canadian dollar. Okay. I'm a bear. I'm on the US dollar. I'm a bull. So
forget about that. But does the scandal make you more or less willing to buy or sell the Canadian dollar?
I don't even know if it is the big input variable for me.
Yeah, so I kind of agree with you that it's not a huge deal. But when I think about it, if I'm a global investor and I look at this and I go, well, the Liberals might lose. The Liberals are kind of our Democrats for our American friends. The Liberals might lose, and this gives further kind of let's just say tilts the balance a little more in the favor of the Conservatives. You might argue that the scandal is actually positive for the Canadian dollar, wouldn't you?
I actually never thought about it that way.
Yeah,
I'm not. You know what? I'm not going to say something off the cuff there because, for me, look at this. All right, like I'm going to look at it in the way I like to look at it. Listen, forex traders are always looking at the USD/CAD, but I look at the Canadian dollar itself, and I see this rollover. I still want to be bearish the CAD. Maybe the Aussie is still going to weaken greater and faster than the CAD, so maybe your pairing will work out. I'm not opposed to your trade, but I still suspect there's vulnerability for the Canadian dollar to head to 70 cents on the dollar. I still think that's a real risk. But what's interesting is as the Canadian dollar is weakening, we had an uptick on the Canadian TSX, and I am shocked by this rip higher.
It's crazy, isn't it? Like what is that number? Like how much is that up?
On a percentage basis from the December low, the TSX 60 in Canada is up 16%. Not as much as the S&P 500, which is up like 20%. So even though this looks parabolic on a comparative basis, this actually isn't on a percentage basis as big. But it's still on the chart. We're basically back to the summer highs. Not all the way to a double top, but we're in that range now, right?
Yeah, it's crazy.
But what's amazing is that look at the Aussie 200, right? Like when you go to you look at what's happening in Australia. Where the hell do I have it here? Hold on a second. What the hell? Where do I have it here?
It's that you don't follow the Australian.
No, I do.
Right?
Hold on a second here. I got it
our
here.
Australian listeners, all 7 of them are going to be upset.
All 7 of them. Here we go. Hold on a second.
We might have 8.
There we go. Okay, look at that.
We keep losing them.
Tell me that the Aussie 200 here does not look like a mirror image of the Canadian TSX.
A mirror image? No.
Well, not a mirror image, but it's got what?
It looks the same to me.
That's what I mean.
Yeah. Well, okay. I guess what you're saying. Mirror to me.
Like
implies it's going down.
I mean in the correlation.
Yeah.
The correlation. Here, let me just put the
Yeah,
TSX.
but listen, Australian stock market is ripping because the central bank has indicated they're going to be more easy because of the
really
fact that
look at the core.
Yeah.
This is Canada overlaid on Aussie.
Yeah, no, listen.
Yeah, and you think that Aussie policy is driving it? I feel that even though Australia is on the exact opposite side of the world of Canada, we share one thing in common. I mean, beyond the fact that Australians love hockey, but beyond that, is the fact that we're both resource nations, right? I mean, about roughly the same populations, and we're resource-driven economies. And so, the reflation pushes in the world very much are driven equally in the two countries. No.
Yeah, well, that was the whole reason for my trade was that I wanted to take out the U.S. dollar element of it, and I wanted to basically bet China versus the U.S. And I still contend that Australia's biggest trading partner is China.
So does it make you nervous that China?
Does
it make you nervous that China did this massive social financing surge, this big credit surge that just happened? Like, does that change your narrative at all?
Well. No, I think ultimately that China is still on that political cycle where they're going to want their economy to be flying in 2021, not in 2019. I think this was a little bit of just them trying to slow the decline. And maybe it's a little bit like when the guys at Bre-X were salting the mine samples and they put a little too much gold and they said, oh, let's just go with it. I feel like they might have overdone it a little, but I suspect
just overdone it a little bit.
They're not
just salting it a little bit too much. Listen, quick question for you though: Are you a buyer or seller of Canada here on the equity side?
I'm a seller.
I'm with you. So that means everyone should buy because when me and you agree, there's got to be a problem. But this has gone too far for me. I think it's crazy. But let's see how it plays out. Number 2, though, Kev, we obviously have central banks around the world, right?
It's like just a deluge of different central banks that are going to be announcing next week. We have the BOE, Bank of England, Bank of Canada, and the ECB, and it's going to be interesting to see what they say.
Right. Well, this is important. I'm dabbling with my foot just slightly in the water with some euro shorts, but I won't say it's any meaningful position yet. And so I'm very curious how things develop in Europe. But I'm as Canadians, I know look, Stephen Polos in Canada is not doing anything.
Well, the real worry is that he gets out and he's more kind of dovish than everyone's expecting.
You think that's the risk?
Well, I think that's the risk, especially given this recent GDP number that shit the bed. Yeah. But you know what I think is interesting is the fact that the BOE, the Bank of England, have you looked at the number of hedge funds that have are just kind of balls to the wall long? It's shocking to me. Like
long the pound, sterling?
It's one of the favorite trades out there, and it
really
just gives me. Yeah. Oh no, they love it.
I was so curious about what where this move has been coming from. Like when you look at what's happening here, this is your pound sterling, and it had this little retrace, and then it just blasted off. But is this like gold? Where it's now kind of approaching all of these highs up along here, and is it just going to bump its head, or is this for real?
It definitely feels to me like the hedge funds are just piling in. I saw my favorite guy, Crispin O'Day, which is one of the guys that he's.
Oh, he's your favorite guy, eh?
Oh man, he's crazy. His fund goes up and down like 50% a year. Like how people stay with that guy is beyond me. Yeah. I love him though because he's old school.
He's got
just like let's go for it.
Yeah,
he's huge personality, and I would love to go drinking with him. He seems like just so much more fun than these other guys that are just asset gatherers. He's just like, no, screw that, I'm going for it, and he's just old school. So I love him, and he's always bearish. He's kind of thinks the world's coming to an end. He's kind of like you. And
Yeah, a little bit.
I saw the other day that he was like long the pound. I was like, what the hell's, what the hell? Like, this is one of the guys that is the most bearish all the time. And it gives me pause when I see how many guys, are buying pounds, and it worries me that this move in the pound that's been recent is just a function of all the big guys getting in. I do want you to bring up
you're
one
convincing
chart.
me to go short.
Yeah, well, one chart that I think that is kind of the other side of my trade that you might want to look at the euro pound. And to me, that thing looks more like if I was to buy the pound, I would rather do it against the euro than against the dollar. And can you pull up that chart for me, Patrick? To me, like, go kind of euro pound and go kind of a little bit longer out, and you can see that it's breaking down and it's moved a long way. And that to me is a better trade than just owning the pound against the dollar. That's to me what you should be playing.
Right. So you know what? And what's your thinking here, though, where this goes? You think the euro is going to, on a relative basis, continue to underperform? Or do you think that this takes off and the pound is the weaker one?
No, I'm saying I think that the euro is a short against the pound, and I would rather not play the pound against the dollar. And maybe that's a theme that I have, is that I'm scared
just
about
trying to
the
remove
dollar.
the dollar from the equation, right?
And I think that that's a much better trade than just straight outright pound against dollars.
Yeah, that's interesting.
Yeah.
Number one, though, Kev.
The unemployment numbers or employment numbers.
And that's both in U.S. and Canada coming out at the same time.
Yeah, and again, we're all just waiting for that one kind of definitive economic release that tells us which way we're going, whether it's everything's okay, we're not going to kind of slip back into a recession or into a slowdown, or it is upon us, and the slowdown that we've been kind of fearing in terms of the U.S. is finally here. Right. And I think that the employment numbers might be one of those kind of.
You know what? My intuition, Kev, is that the employment numbers will be one of the last things to confirm an economic slowdown. I actually suspect that going with the narrative that I built, which is whether or not you subscribe to it or not, that the economic slowdown is going to start globally and be driven globally first. I think that U.S. jobs and U.S. employment will be one of the laggards. I don't think in any way it'll have any leading effect. I think that by the time the employment numbers really shift, we're going to already be in a recession.
Well, that's traditionally what's happened. You're bang on correct. It's a backward-looking indicator. But one of the things is that a lot of the forward-looking indicators, the ISM and stuff, have already rolled over. And the question is that more noisy, and is that real, or are we in a situation? And I think that that's what the employment number might or might not do, is confirm the noisier kind of high frequency numbers. So although I agree with you, I still think that a bad number could surprise a lot of people and put the kind of U.S. slowdown back, on the table.
Right. Oh, you know what? Everyone now has the top 5 things to watch next week. Kev, let's wrap up with the parting words of wisdom. What do we have?
We got something from Charles Dow, and it says,
one of my favorites, by the way.
You tell me he's a technician.
He's a technician for sure. Yeah. Dow theory comes from Charles Dow.
Oh, I didn't know.
He was the founder of the Wall Street Journal, right?
And he came up with the Dow theory. And did he know about squiggles?
Well, actually, he wrote a whole bunch of articles in the Wall Street Journal, which were this is to the best of my knowledge, but that were all compiled by others afterwards that came up with Dow theory. But it wasn't ever Dow himself, Charles Dow, that actually created Dow theory. It was all of his works that were compiled that created Dow theory. But anyway, yes, it all came from him, though. But anyway, what did he have in mind?
Let me just read you his quote. Pride of opinion has been responsible for the downfall of more men on Wall Street than any other factor. I thought that was just a great quote.
It is not the first time I heard that. I've actually taken that to heart.
Yeah.
It's so important as traders for us to have humility. This is why I love the way that we do the shows, because we make fun of each other. You got to keep yourselves real, because the one thing is that some people just get kind of trapped in one idea that they went too all in on, and they don't know how to back themselves out of it. And they're wrong, but they can't admit they're wrong. And one of the most important things to being a successful trader is the preservation of capital. And one of the best things you can do to preserve capital is to be able to admit you're wrong early enough in the game,
Yeah.
right?
Well said, Patrick. Although I see pride of opinion has been responsible for the downfall of more men on Wall Street, I think it's a close second to weekly options. Those things are just like, anyways, if you trade weekly options, you understand that those things are just like gambling often. But anyways, it's like Charles Dow with some wise words. He obviously never traded weekly options, but otherwise some wise words to end our show with. And for those, make sure you stick around. Steve joined us for an extended version. But otherwise, Patrick, let's just go through here where we can find each other and what we should be doing. And don't forget to sign up for the Market Huddle email, especially this time, so you can find out where you can find Steve and all his information.
Those of you that enjoyed the show, first of all, make sure you subscribe to the channel on YouTube. If you're listening to the podcast, make sure you subscribe to the podcast and come to the website if you want to get the email update as to when the show is launched, and more importantly, the links to all the chart books and all the other cool stuff that we include in there. Make sure you come in there and register. You could follow us on Twitter at the Market Huddle. And as well, you can follow Kevin Muir at Kevin Muir, and myself at Patrick Ceresna on Twitter. Any other closing remarks we forgot?
Well, no, we have to give a big shout out to our sponsor, Green Bastard IPA.
Yeah.
I
had no idea that this was a Trailer Park Boys beer.
Yeah, no.
It was, at first it was a little bit of a surprise how strong it was, but it actually ended up, I ended up enjoying it. It was actually pretty good.
So there we go. Trailer Park Boy
Listen,
beer.
I'm not going to shit on every sponsor. I'm going to reserve that for the beers that actually suck.
Yeah.
And so, like, if I shit on every beer, then how do you know which one sucks?
Well, that's true. So you know what? You can take heart that Patrick is true to what he believes in. He does not just because the sponsor is paying us to put, them front and center on our podcast. We have too much integrity to say if it's a shit beer or not. Regardless of what we say. So you can count on Patrick to be truthful to that. I, on the other hand, have no such integrity and will say that Green Bastard IPA is a terrific beer, and I enjoyed the 3 of them that I had. Thank you very much, everyone. Have a great week trading, and we'll see you next week.
We'll see you all next week. And then stick around here for Steve's continued conversation. Thanks, everyone. All right, Steve, we're here in the post game here and after the show, and just continuing on from where we left off. What I wanted to first of all just thank you for coming on to the show, because I think it was back in 2015 where I had the opportunity to meet you for the first time. You came up to Canada you're out in Connecticut, right?
Yep.
Yeah, and so you came up to Canada, and we went and did a little tour with the Montreal Exchange promoting Canadian options, and so I had a chance to meet, and we chatted along the way. Unfortunately for our listeners that were hoping to get some insights from you from a market making perspective, we apologize that you're not going to get anything from Steve. There's a logistical issue that we'll cross that bridge and get Steve back on afterwards, but we're not going to dive into that. But anyway, Steve, you wanted to throw a couple cheap shots at the Toronto Maple Leafs. What's going on here?
Well, here's the thing. I mean, I grew up on Long Island, and I'm a proud fan of the lone team that plays there. and I would like, and I was thinking, because last night as I was watching the hockey game that some of you may have kept an eye on, that there's a real lesson in here that if you assemble a great group, you can actually, as long as you're well managed and as long as you have a really good game plan, you can withstand the loss of whoever the most important person is to your team, and sometimes actually do quite a bit better. And, and it doesn't even matter what kind of pajamas they wear. And that this way. I do have to apologize, by the way, for the folks who do live. That was a bit much.
No, it wasn't. It's great. First of all, Kevin is a Winnipegger, so he's a Winnipeg Jets fan, and so he enjoys watching you trash talk the Leafs. But you know what? I for one, I have to agree. I'm not going to disagree because it is a team game. You look at Edmonton Oilers and they can have McDavid there, and it doesn't matter. It's one player doesn't make a team. You need the whole package, right?
I'm just amazed right now, and I've suffered with this team for a while, and you guys and you
we suffered with the Leafs
for a long. Yeah. You've suffered with the Leafs for a long time too, and the fact that you guys let Lou Lamoriello go, and the fact that the Capitals let Barry Trotz go, and that we managed to get both of them, and you took and literally you really did take the same team. Effectively, we swapped out John Tavares for Leo Komarov, and Leo Komarov and a system, and look what happened.
Yeah,
and it's just so I don't. It's the first time I've had a chance to gloat on a hockey sense for I don't know since the '80s. So I'm I just had to do it,
what?
especially last night. What
I would love nothing more than the Leafs and Islanders to meet in the playoffs at some point. That I think would be pretty epic.
It was I was half waiting for Darcy Tucker to come out and give someone a knee hit last night.
All right. Anyway, Steve.
But I have a feeling it'll look very chippy.
All right, Steve. Was there anything on your mind that you still wanted to share with us? Like, what's your thinking on? Do you have any views on the currencies or bonds or anything else on the bigger picture that you sort of wanted to kind of get on record?
Well, I think we touched upon the two things, that I want on the bond side that I thought were most important, which was, the composition of credit type of thing. By the way, while I did the old anecdotes, I remember one of the first things that one of the first big research reports that I remember, like when I was on the street. This was Salomon Brothers, like 1987, as I was in the training class. I wasn't in the Liar's Poker's training class. I was the next year. But and that was that Henry Kaufman wrote this big report. He was, Dr. Doom, I think was his title. It was his nickname. About the I forget what it was, like the decomposition of credit or something. And at that point, it was how we were just a steady decline of AAAs, and that the bond market was at risk because the AAAs were disappearing, and we were getting more into and that the investment grade was being dominated by single A and double A. And here we are, the same conversation all these years later, and it's like triple B.
Wow.
And hanging on to the edge of the precipice. So that's been sort of a one-way street, for 30 years. So I think it's more meaningful now because no one wants to fall off that cliff from investment grade to junk. But that's been a concern. That's been a backdrop concern. Credit has been moving in one direction and one direction only, and that's sort of worse. The balance sheet worsening over time. People have just gotten so much more inured to leverage on a balance sheet. That's out there, and the negative interest rates until or unless Europe can actually maintain a positive interest rate, a non-zero interest rate in the biggest economies, it's hard to make a case for the world economy zooming ahead.
Okay, can I interrupt here? So it's Kevin speaking. I have two questions for you. First of all, I didn't realize you were on the Salomon Brothers kind of training class. And the first question I have is, was the guy that came out and talked about the fuck face or whatever, he's like getting your face fucking ripped off from the Michael Lewis novel, was he in? Did he speak to you guys?
Yep.
Yes.
Oh, no. I know who. I know. I all those people that he mentioned. I pretty much knew who he was talking about because they were.
Oh, that's awesome.
So when he came out and said you're going to get your fucking face ripped off and all that stuff, that was like for sure he came to the kind of training kind of class and said those things.
Yeah, what happened was you would go through the class. You came in. I actually came in off semester. I got hired. It's a long story, but I got my MBA right on top of my bachelor's degree. And so this was a raging bull market. So I was able to push them back 6 months. So at this point, they were running 2 training classes a year. So I was January '87. I was supposed to be July of '86. But I pushed them back and put a backpack on and went around the world for a while. That's how I ended up in the foreign equity area. But basically what you would do is it was in many ways like a college setting. You had your little class and your little group, and you had this room, and it was a training room, and different people from around the firm would come in and tell you what you would do. And of course, there was also you'd kind of get your Series 7 and your Series 3 and some of these other things, get your licenses as well. But they would come in and talk about what they did. And in some ways they were selling their area of the firm because they wanted the best, as the firm was growing, they wanted to be able to get the best crop of people from the training class. So then you would do these rotations and you'd go around, and there were certain guys who went through that group, and you're just like, oh crap, I don't want to be anywhere near this guy.
Dallas and equities in Dallas, right?
Equities in Dallas. Now I will say that as someone who did choose equities, I actually, everybody thought I was going to government bonds, and the reason I didn't do it was I got a weird vibe from the guy who I would have been working for, and he ended up getting indicted a few years later because of the Salomon Brothers Treasury bonds.
He was the fixing guy, the guy that fixed that submitted bids illegally.
Yep.
Ah.
Yep. So I dodged that one. I would have been a government bond trader working for him, having either. So I'm glad that was a good miss. So I ended up going down. I liked equities. It was more rough and tumble, and that's the one thing Liar's Poker gets wrong. Is it's very because he wasn't on the equity floor. His stuff about the crash was very superficial. It's a lot of guys screaming and yelling at each other. Yeah, of course it was, but you missed a lot of stuff, and we could do a whole hour on what happened, on those 2 days. But essentially, that was the short version is the system locked up. There was a coordinated effort among all the firms, of which Salomon was one of them. With the Fed backstopping everybody, and because everybody remembers Black Monday, but Black Tuesday was worse because at that point the whole system had locked up, and it basically took a major intervention. All the firms basically. I want all you fuckers to call down on the floor and find out what the fuck it would take you to open up any of these stocks that you fucking trade that are not open yet. Cigar-filled room, and that's the real story. And I just don't have the time to do that one.
One of the issues.
That's the story, and Michael Lewis didn't get it.
Right. One of the issues with that was not the fact that the futures, which were a lot of the ARB guys, and I remember reading this somewhere, was the fact that if you were sitting there on the Salomon Brothers, I believe you guys were one of the biggest index ARB guys at the time. If you were sitting there and you were buying futures at a discount and selling stocks, you had a mark to market on your futures, which were collapsing, that you were actually having to come up with the margin that day or later that day. And meanwhile, the stocks, and which back then they had a 5-day settlement. So you weren't actually getting the money that you needed to actually, submit it to the from the New York Stock Exchange to the CB, I guess it was the CME at the time, the Chicago Merc, and there was a mismatch in terms of these futures products. And I remember reading books where they said that they had stopped guys from doing the index arb because of this problem, and there was a whole bunch of firms that were threatening to go under, and the Fed had to force the banks to kind of lend the money unsecured, to fix this mismatch in terms of timing. Was that kind of
basically that's basically true. I mean, they joke about the plunge protection team, but that really was the plunge protection team, and that was really the biggest example. But what happened was, we got in that Tuesday morning, and the morning meeting was essentially the specialist system is bankrupt. So you can't rely on these guys to make markets. And that's what happened, because you woke up Tuesday, and first of all, there was the portfolio insurance idea. So that was that you could always rehead your portfolio by selling futures, which is great, except anybody, when you really think it through, that just always assumes that there's a bid in the futures. But if everybody's trying to do the same trade at the same time, there was no reasonable bid at the futures. That's why they were at such a discount. And what you then had was, the specialist firms who had been, buying on the, forced to make a two-sided market. These were small, somewhat poorly capitalized firms. So these guys really were sort of technically bankrupt. So when the selling came back on Tuesday, I think they were hoping to sell out of some of this stuff. Some of the stuff they went home long on Monday, but they were just out of it. So literally there were no bids, and literally most stocks were offered only. There was no bid because there was no one to step in. What happened was, so the Fed, and this is, I wasn't in the room. I was, my job at that point was literally moving the NASDAQ markets and not picking up the phone. so that we would not be on the bid in any of the stocks that we had a NASDAQ responsibility. I remember I wore both hats from a very early point. As trading OTC and listed, and basically as the junior guy on the desk was just me and one of the other junior guys just moving the prices. If we're on the bid, get it down, and if the phone rang, don't pick it up and figure out what you're on the bid on so you can get down, so you didn't have to trade. That's really what I spent literally 2 days doing. But what happened was, at that point, you could just see that the game around noon, it was it. There was nothing. There was literally nothing going on because there was nothing trading. There were, all these stocks had, were to the sell side. There were no bids. The futures had basically locked up because you couldn't do the ARB anymore because of the timing mismatch, and because there is no ARB, because if you can't sell the stock, what's really the price? There is no ARB, and so. I don't know, the big smoke-filled room. This was a time people still smoked cigars, and you could always smell John Goodfriend coming because his cigar. You have the smell of the cigar ahead of him, and so they all get in a room. And I remember hearing things like Stanley was Stanley Shopwood, Stanley Mnuchin, which that was Father Mnuchin, not the president, the father of the Treasury Secretary, who was basically the equivalent guy at Goldman Sachs. And from what I gathered. Basically, it was some conference call with like the Fed and Goldman and Morgan and a few of the bigger trading firms, and they, that's when he came out and said, "I want all you guys to find out what it would take to clear any imbalances." Now, think of the psychology of this: the market's frozen, and then the Salomon Brothers brokers asked this question at the same time as the Goldman Sachs brokers, at the same time as the Morgan Stanley brokers. I'm not sure who else was in this, group, Lehman Brothers, probably some others. All of a sudden, the guys on the floor, they're not stupid. It had as much of a psychological effect. So we didn't actually buy as much as you'd think, because the mere fact that it was obvious that all these firms ran into the crowds at the same time to try to clear the imbalances, in effect cleared the imbalances for them. Cancel that sell order.
It's like J.P. Morgan in 1907 or whatever it was.
Same basic strategy, yeah. But that was J.P. Morgan as a person. In this case, the part of J.P. Morgan was played in that production by Alan Greenspan.
Right. Okay.
But largely, yeah.
Wow.
So there you've got some good anecdotes out of me. Damn it. I don't know what I'm going to bring next time you have me on.
I'm pretty sure you're going to figure something out. There's a lot more I'm sure that we can get into. So my second part of it was, okay, so we were talking about that, and I'm just trying to remember what you had said in terms of I had 2 points that I wanted to ask you in terms of the markets, but now I've completely forgotten. Patrick, why don't you just take it away? Because I you know what, I'm kind of 2 beers into this, and I'm actually enjoying our beers. So why don't you go,
what?
Patrick?
I'm dying to step away here to go grab another pint. I'm like too
you
far
don't-
away from the fridge.
Patrick, you have to understand, you got to put them all beside you so that you can do it Tony Greer style.
Yeah,
and
no,
just kind of keep popping
just
them
keep the
like as they come
6-pack right beside me here, so I can just keep them cracking. Right, like the fool in me is like, I'm gonna keep them cold in the fridge, but I'm realizing that I'm stuck to this microphone. But
Okay, so Steve, I
Well,
have
I'm several behind.
Yeah, that's right. You're gonna have to
Because
get
my
out to
office
the
is
bar
dry,
right
so
away.
I can't drink on the desk, so I gotta catch up later.
That's right. So, Steve, here I have a question for you. Do you think, I see that I think Dudley came out today, one of the Fed board, the FOMC kind of board members, and he started talking about threatening to raise rates in the second half of 2019. And so far, this is the first thing we've heard in terms of a Fed kind of getting cold feet, a Fed member getting cold feet and trying to tamp down kind of expectations. Do you think this is the start of something more that we're going to see?
I think he just I took that to mean that he didn't really want to. I think what he's getting concerned about is, I'm a big consumer of the WIRP page on Bloomberg, the WIRP, as
right.
it were. And that's got the rate hike probabilities, and I pulled it up now as we're talking. You've got a 7% probability out to the end of the year, and actually it declines as you get into 2020, about 6%. And so I think this is his way of saying, hey, back up here a little bit. We're not, just because we talk an accommodative game doesn't mean we're necessarily going to accommodate. And I think those of you who, we went from the likelihood of 2 rate hikes to essentially 0 in a very short period of time, and now you have people starting to talk about rate cuts in 2020. I think these guys really are trying to just keep a little balance here. I think it's just not.
Yeah. So if you look,
I don't want to read too much into it.
But if you go look at the euro dollar, I look at the March 9, 2019 versus March 2020 spread.
Here, I'll
and kind
pull
of
it up.
that's basically the amount of easing or hiking that we could expect, coming from March 2019 to 2020. Now, this is the euro dollar, so obviously it's not perfect versus Fed funds, because you do have that kind of LIBOR versus Fed funds risk, but it's kind of indicative of what the market expects. And we'd reached a point where just 2 days ago it was trading minus 10 basis points, and today we kind of poked our head above 2 basis points. So for the first time, it's gone from them expecting a cut, or at least somewhat of a cut, or the probability of a cut, to now going the other way. So
it's still hovering 0 though, Kev, because
I get it.
If you go to 2020, when you go December 2019, December 2020, we're still negative 14 basis points. So there's still the likelihood of a cut next year is still there. It's really the likelihood that this year there's a cut is pretty much.
But you know what, Patrick, I find most amazing is, go pull up December 2019 euro dollar futures. Just let's look at that chart. Just straight out, December
right
2019
here.
futures. So as we've rallied and we've had this rip-roaring, risk-on rally, it's been shocking to me that until today, or until the last 2 days really, this has been trending higher, meaning that they've expected kind of lower rates. And it's been usually when you get a rip-roaring kind of risk rally, they at very least keep, let's say interest rate expectations flat. They're not pricing in increasing chances of kind of an ease. And what worries me is when I look at that, it kind of, this leads further credence to the argument that we've been kind of, the short squeeze thesis might be correct in that we've kind of been squeezed up by the Fed, going dovish or at the very least going less hawkish, and it's forced everyone kind of into risk assets. And the reality is that the Fed's not that comfortable with it, and as risk assets rally, eventually we're going to see a reaction function out of the Fed, and they're going to at the very least say, hey, whoa, we're not going to ease, and if anything, we're going to raise. And that's what I worry about. I don't know if the market's ready for that.
It's not. That would be ugly. But then again, we're talking about, we've had a whole discussion about how the economy is going to be tepid at best. I think you get into stasis, but I do think they want to balance the risks. I think that's crucial to them, and I think the market's kind of lost that sense.
Well, Steve, listen, it was so great having you on the show. Thank you so much for giving us your time, and I think that it was great. Any closing words there, Kev?
No, I just want to thank Steve. Like, that was I'm still laughing at the calling in fat. Like, that was one of the greatest stories I've heard in a long, long time. So I really appreciate you coming, Steve. It was a pleasure meeting you, and we look forward to having you on again.
I'm looking forward to it already.
All right.
Take care.
Thanks a lot. All right. Cheers.